In the second video on investment portfolio strategy, we will cover asset classes. This is a long video because there is much to cover. However, one can jump to the final summary and get everything needed if they do not want the justification for the asset classes on my list. An asset class is a unique opportunity in which to invest your money. How to determine if something is worthy to be considered an asset class is very important. We could say every single asset in the world is an asset class. Each individual stock, each individual bond, each piece of real estate, each commodity, all could be an asset class, but that would give us tens, if not hundreds of thousands of asset classes. Given that we need to come up with investment expectations for each asset class, that would be way too many asset classes to deal with in any reasonable way. We could just have 3 asset classes, maybe stocks, bonds, and everything else. That would greatly reduce our workload in coming up with assumptions, but we would miss out on some unique opportunities within those asset classes. The goal is to have enough asset classes to be able to adequately explain the investment opportunities around the world, but no more. Having one more asset class than is necessary is just extra work without any benefit. Figuring out the correct number of asset classes and then listing those asset classes draws on several theories in finance, and many are really beyond the scope of this video series. If you are interested in delving into that topic, you can find more detailed discussions in several of the class videos from my classes and from other videos online. A good source on this topic is a series of YouTube interviews under the caption "In Pursuit of the Perfect Portfolio." This series covers many topics related to asset classes and includes interviews with some of the giants in finance. For this video series, I am going to cover a traditional and well-recognized list of asset classes. There is some debate on a few of these items, but the majority of my list would be consistent with the list you would find at all major wealth management firms. In other words, trust me on this, it is a perfectly fine list of asset classes for all investors preparing for retirement. I break the asset classes into 4 major categories: cash, bonds or fixed income, stocks, sometimes called equities, and alternatives. For cash and bonds, these are really the same thing. These asset classes are created when we loan someone else money. We need not have ownership in the business we are lending to. We simply want them to pay us interest on the loan until the loan matures, and then at maturity to repay us what we loaned them. The difference between cash and fixed income is how long the loan period is. Cash is an investment in loans that mature in 1 year or less. Cash also includes the most liquid investments we make, such as what we hold in our checking and savings accounts. Fixed income represents loans we make that mature in more than 1 year. A 6-month certificate of deposit we get from a bank would fall into our cash category, while a certificate of deposit that matures in 5 years would fall into our fixed income category. Most wealth managers do not actually consider cash to be a legitimate long-term investment option. Cash is what we hold in our emergency fund and what we hold when we are worried about markets crashing. This latter is known as sitting on the sidelines. The biggest risk with cash is that interest rates fall significantly and we end up making very low returns on cash. This is known as reinvestment risk. However, cash is almost always priced at the amount we originally paid for the investment. That is, it is always valued at par value. This means our investment in cash should not drop in value. Only the interest we are making on the cash will go up and down as interest rates change. So we can say that cash has very low price risk, but it has very high reinvestment risk. Now we turn to fixed income, which, like cash, is an investment where we are loaning money to corporations, governments, other entities, and to consumers. While cash is short maturity loans, fixed income is loans with a maturity of 1 year or longer. Fixed income will have varying degrees of reinvestment risk, with shorter maturity fixed income having more reinvestment risk. and has varying degrees of price risk, with longer maturity fixed income having the highest price risk. With cash, we just lumped all cash investments into one category called cash. However, with fixed income, we need to break this asset class into several sub-asset classes. I like to use the mnemonic DC cuts I. The first two letters, D and C, stand for duration and convexity, which are two measures in finance to understand how a fixed income investment's price will change due to changes in interest rates. We will be focusing on duration, as convexity is quite a complex concept and usually not one a typical retail investor would be concerned about. And then the next letters, C, the second C, stands for credit, which is an assessment of the quality of a fixed income investment. That is a very important factor for retail investors to consider. The next letter, U, stands for U.S. versus non-U.S. fixed income. We will ignore this as we will consider only U.S. fixed income investments. It is rare for retail investors to include non-U.S. fixed income investments in their portfolios because the risk of currency losses really dominates these investments. The next letter, T, stands for taxes. Some fixed income investments are exempt from federal and state income taxes, and this can be an important consideration for many investors. The last two letters, S and I, stand for structure and inflation. We will be ignoring structure as that is one of the most complex parts of finance and is a decision most retail investors will leave to their portfolio manager rather than establishing their own strategy. We will also not get into inflation. There is a bond in the United States. It's called the Treasury Inflation Protected Security, or TIPS, that do provide protection from inflation. That sounds like it could be a great investment after a year like 2022 with high inflation. However, TIPS are a quite complex security and do not always perform as expected. In fact, TIPS fell in value in 2022 even with the high inflation. So our focus will be on duration, credit, and taxes. For duration, or maybe a little more comfortable term, maturity, an investor wants to think about what exposure they want. As I said before, bonds with high or long duration are more sensitive to interest rate changes. That is, when interest rates rise, long duration bonds will fall the most in value versus shorter term duration bonds. The industry usually helps you make this decision by offering fixed income investments in three categories: short term, intermediate term, and long term. If we expect interest rates to rise, we would prefer short-term investments, and if we expect interest rates to fall, we would prefer longer-term investments. Most retail investors split the difference and stay almost entirely in the intermediate term category. For credit, the question here is how much risk do you want to take that a bond will not pay you back because the borrower has gone bankrupt and has thus defaulted on their bond. The industry helps us with this decision by breaking fixed income investments into high quality, medium quality, and low quality. High quality would include bonds issued by the U.S. federal government and bonds issued by high quality corporations. Medium quality would be bonds issued by most corporations with good but not the highest credit quality. And then low quality bonds are what is often called high yield bonds, also known as junk bonds or below investment grade bonds. Credit rating agencies like Moody's and Standard & Poor's rate these bonds starting with the highest rating of AAA going all the way down to the rating of D for a bond that is in default. Below investment grade bonds are those bonds with ratings that are below BBB, as BBB is a medium quality bond at the lowest rating to still be considered investment grade. High quality bonds will do better in a recession when one would expect medium and low quality bonds to be much more likely to go bankrupt. Medium and low quality bonds will do well when the economy is turning positive as their probability of default is falling. Medium and low quality bonds pay higher interest rates to compensate investors for the higher risk, and one would want to capture these higher returns when you are confident the economy is going to do well. by buying medium and low quality bonds. Finally, for taxes, someone who has a high taxable income can shield some of that income from taxes by buying tax-exempt bonds, like municipal bonds. We will cover that analysis when we discuss portfolio execution later. In summary, for fixed income, you need to decide on duration, which is short-term, intermediate term, or long-term bonds, and you need to decide on credit quality, which is high quality, medium quality, or low quality. This table displays how each does in different environments. In this quadrant, we have an economy that is strong with rising interest rates. Here you would want to be holding short-term bonds to protect against rising interest rates and low-quality bonds to pick up the higher return. In this quadrant, where we expect a recession and interest rates to fall, you would want long-term bonds that will rise significantly in price as interest rates fall, and high-quality bonds that will not be likely to default in a weak economy. The other two environments are not common: a weak economy with rising interest rates or a strong economy with falling interest rates. Those are not common. We saw the first one in the 1970s, a period referred to as stagflation, with a weak economy, but interest rates were rising because of inflation from the oil embargo. In that decade, your only real good option would have been short-term, high-quality bonds, and that is a pretty boring but safe option. In the 1980s, we saw a strong economy, but interest rates were falling because the Federal Reserve had already fixed the high inflation of the 1970s. In that case, long-term, low-quality bonds did exceptionally well, as did stocks. Most people are not good at forecasting economies or interest rates. In fact, few economists are all that good at forecasting this either. So most retail investors pick a middle-of-the-road approach. They buy intermediate-term bonds of medium quality. And this is not a bad strategy, though it will have periods of weakness. After deciding on duration and quality, then you need only to assess your tax situation to see if none, some, or most of your fixed income portfolios should be tax-exempt bonds. Now let's turn to stocks. A stock represents ownership in a company, in a publicly traded company. Your return from owning a stock will mostly depend on the performance of the firm, in particular how much profit they make and how fast they are growing their business. We need to understand the difference between good companies and good stocks. A good company is profitable. However, other investors can see that, so that company's stock price will probably be bid up to make it an expensive stock. So the question is not if the company is a good company, but if the price of the stock already reflects how well the company is doing. If it does, there is no advantage in buying the stock of that company. You are buying a good company stock, but paying a premium price for it. Another company might be struggling and have lost money recently. That might be a bad company, at least temporarily, but if the stock market over-penalizes the company's stock such that the stock price is too low, then a bad company can be a good stock. As Howard Marks at Oak Tree Capital likes to say, there are no bad assets, just bad prices. There are tens of thousands of stocks one can buy in companies around the world, so we need to put stocks into subcategories just as we did with fixed income. I like to use the mnemonic BUCS, B-U-C-S, for stocks. The B stands for beta, the U stands for U.S. versus non-U.S., just like we had with fixed income. The C stands for capitalization, and the S stands for style. First, the B, beta. Beta is a term we use in finance to speak to our overall exposure to the cyclical nature of the economy. There are two types of stocks: cyclical stocks that are more sensitive to economic cycles. These stocks generally do very well when the economy is doing well and very poorly when the economy is weak. Cyclical stocks include consumer discretionary companies like high-end retail like Nordstrom's, auto manufacturers like Ford and GM, travel and leisure companies like cruise lines and airlines. That is, those companies who would lose customers when the economy is weak and when consumers are worried about losing their jobs and thus cut back on their discretionary spending. Cyclical stocks are also known as high beta stocks. Defensive stocks are companies that do relatively well when the economy is weak, but will trail cyclical stock performance when economies are strong. Defensive stocks, also known as low beta stocks, include companies like consumer staples like grocery stores, discount stores like Costco and Walmart, and includes utilities. If you believe the economy is headed for a recession, then you would want to reduce your overall allocation to stocks, and within your stock portfolio, you would want to move away from cyclical stocks and move toward defensive stocks. And vice versa, if you are in a recession but expect the economy to bounce back, you would want to increase your overall allocation to stocks, and within stocks, increase your investment in cyclical stocks and reduce your investment in value stocks. If you are not sure, then you want to make sure you are well balanced between high and low beta stocks, not making too much of a bet in either direction. The second letter in BUCS is the U, but it makes more sense to cover the C and the S before the U, so we keep our discussion of U.S. stocks all together before moving to non-U.S. stocks. So second, let's talk about C, which is capitalization. Capitalization is simply how big the company is. The largest company in the U.S. right now is Apple. A company at the time of this video was a $3 trillion company. Apple would be classified as a large capitalization or a large cap company. We generally break U.S. stocks into three categories: large cap, medium cap or mid cap, and small cap. There are also micro cap and penny stocks, but most do not include those in their stock categories because they are very specialized areas of investing. So for us, we will go with large cap, mid cap, and small cap. These tend to all be highly correlated with each other, so there is not much diversification benefit by investing between them. However, at the extremes of very strong and very weak economic growth, they do behave very differently. If you expect a weak economy, you would want to reduce your investment to smaller companies and increase your investment to larger companies. Larger companies generally perform better in weak economies as they have much larger resources to draw upon. However, if you expect a strong economy, that would be a good time to increase your investment in small cap stocks. If you are like most investors and are not good at forecasting the economy, then try to have some exposure to large, some exposure to mid, and some exposure to small cap stocks. Though the majority of your portfolio will probably be in large cap stocks because they are the vast majority of the U.S. stock market. Next is the S of BUCS, which is styles. Stocks are often classified as either growth stocks or value stocks. Growth stocks have high expected future earnings growth as expressed in their high valuations. Often this is reflected in what we call high PE ratios. A high PE ratio or price to earnings ratio shows how much you are paying for a stock relative to its earnings. The higher the PE ratio, the more expensive the stock. And the stock is probably more expensive because investors expect it to grow faster than companies with lower PE ratios. Value stocks have low expected future earnings growth and are currently going through a challenging time, and this gets expressed in their low valuations, that is, in their low PE ratios. It is very important not to mix up the word value with the word quality. Value stocks mean the stock is cheap. The value stocks are cheap because there is something wrong going on with the company. So value stocks are low quality companies, lower quality companies than growth stocks. As such, growth stocks tend to do better in weaker economies, and value stocks do better in stronger economies. This is beyond the scope of this video series, but growth stocks also tend to do better when interest rates are low, while value stocks do better when interest rates are rising. These relationships do not hold in all cases, so view these as general rules over long periods of time. And lastly, the U of BUCS is U.S. versus non-U.S. stocks. Most investors around the world are guilty of what we in finance call a home country bias. Investors in the U.S. invest much more in U.S. stocks than our markets make up of the world stock market. Similarly, people in Japan invest much more in Japanese stocks than Japan is of the world stock market, and so on. More wealth managers will tell you to have some of your stock portfolio invested outside of the U.S. Not everyone believes this, and the U.S. has definitely dominated the world stock market over the long term and as of late. There are some prominent finance gurus, such as the late Jack Bogle, the founder of Vanguard, who argue that one does not need non-U.S. stocks in their portfolio because large U.S. companies are already doing business around the globe. But most believe investors should have at least 20% of their stocks outside of the U.S. Doing this will diversify your portfolio across different economies and different currencies and hopefully reduce the risk of your portfolio. Outside of the U.S., we generally classify stocks as developed market stocks, emerging market stocks, and frontier market stocks. Developed market stocks are the stocks of companies in larger, more stable, developed markets like countries in Europe, Australia, and Japan. Emerging market stocks are the stocks of companies in fast-growing and developing markets like China, Brazil, and India. These companies have higher expected returns because they are in countries with higher economic growth, but they can be very risky investments. Frontier markets are the stocks of companies in troubled but maybe hopeful countries like Bangladesh, Kenya, and Romania. Most investors avoid frontier markets as this is a very specialized strategy reserved for those who spend a lot of time carefully researching each country and each company. The final group of asset classes falls under the category of alternatives. These asset classes are often very specialized and frequently difficult for average retail investors to invest in. These assets are generally added to portfolios for two reasons. One is to provide diversification, as alternative assets tend to behave very differently than stocks and bonds. Also, the dominant asset classes under the category of alternative assets are real assets, that is, assets one can touch or hold like real estate and commodities. Real assets often are viewed as a good protection from inflation. The major asset class here is real estate. Real estate can include residential real estate like the house one owns and occupies. However, home ownership is a rather unique asset that does not lend itself well to conventional portfolio strategy. First, the homeowner has a huge investment in just one asset sitting in one location, so there is very little diversification. To be truly diversified, one would need to own multiple homes in multiple cities across the country. Also, a house is a depreciating asset, which means its value declines over time due to basic wear and tear. Roofs, fences, appliances, and all parts of the house wear down over time, needing significant resources that must be reinvested. Someone might believe they can get a great return on buying a house for, say, $200,000 and selling it 20 years later for $450,000. But whether that is a good return depends on how much they invested in the house, plus other expenses like property taxes and HOA fees. Plus, even without any of those added costs, a gain of $250,000 over 20 years is only an annual return of 4.1%. So it is not as spectacular of a return as it sounds. And when the person sells a house for $450,000, they need to live somewhere, so must buy another house whose price will also have been rising over time, or rent somewhere, and rent rates will also be much higher 20 years later. So I am going to leave residential real estate out as an asset class. It is part of a person's portfolio as it can provide an important source of funds at the right time. For example, my mom sold her house at the top of the market and is now able to afford her very high assisted living monthly rents by using the proceeds from the sale of her house. And it is fortunate she had purchased the house because it funded most of her retirement portfolio. One can also purchase commercial real estate like office buildings, retail outlets, apartment complexes, industrial complexes, or hotels. However, it is very difficult to diversify a portfolio like this as each property will cost millions. There have been attempts to create a diversified vehicle for pooling funds from multiple investors. These securities, such as real estate investment trusts or REITs and real estate operating companies or REOCs, do provide access to diversified real estate properties through a publicly traded stock that own almost entirely real estate. However, statistical data has shown consistently that these investments behave more like stocks than like real estate. So again, I will be leaving commercial real estate out of my list of alternative assets. Another important category of alternatives is commodities. This includes gold and other precious metals, agricultural products like wheat, coffee, and cattle, and energy like oil and natural gas. There are now products that provide retail investors access to these investments that I will discuss when we get into executing the strategy. These investments can be very volatile, much more volatile than stocks, so one would want to be cautious getting into them without careful planning, but they can provide an important role in a retirement portfolio. Other alternatives such as bitcoins, private equity, infrastructure, artwork, and collectibles are too specialized for this video series and are often very difficult investments for retail investors to gain access to. I'm not saying they are bad investments, but just that anyone wanting to get into a specialized investment class will need to do a great deal of research, as these markets are notorious for taking advantage of unsophisticated investors. In summary, how do we bring all this together? So in this one slide, I'm listing all of the asset classes I am going to consider. I have cash and cash equivalents. There's no sub-asset classes there. When do you want to have cash? In periods of high uncertainty, but normally we don't have cash as an asset class. Then we have bonds. You can see we break out bonds between quality, high quality, and low quality, and duration, short-term and long-term. We have stocks. We have cyclical and defensive stocks. We have small and large cap stocks. We have value and growth stocks, and then we have non-U.S. stocks. And then finally, we have commodities. Now, it looks like if you combine these in all the different groups, you'd end up with just dozens and dozens of asset classes. For example, we have high quality in short term. We could have high quality and intermediate, high quality and long term, medium quality and short, and so on. So you could end up with 9 different asset classes. Same thing with stocks. You could have cyclical small cap. You could have cyclical large cap. You could have cyclical small cap that are value stocks, cyclical small cap that are growth stocks. So it's all these different combinations can become just dozens and dozens of asset classes. However, you'll notice that there is some relationship between these. And it's mainly related to the economy, weak economies and strong economies. And there's also a relationship to interest rates. Are they rising or falling? And as we discussed earlier, interest rates tend to rise during strong economies and tend to fall in weak economies. So what that means is there really aren't as many asset classes as it appears. For example, if you're expecting a really weak economy, you would want high quality bonds and you would want long-term bonds. High quality because you don't want to risk a bond going default when the economy is weak, and long-term because you expect interest rates to fall in a weak economy. Also in a weak economy, you would want low beta defensive stocks, larger stocks, and growth stocks. They tend to do better in weak economies and vice versa. So we don't necessarily have all of these. If your economic outlook is a strong economy, you would want to go lower quality bonds, shorten your duration because you worry about rates rising. You would go to higher beta stocks, smaller company stocks, value stocks. And so when you bring all of that together, it really is not that many combinations because of the link to the economy. As far as U.S. versus non-U.S. stocks, that really is a decision based on what you think the U.S. economy is doing versus other economies. If you're not sure, you stay balanced between them. But if you have a strong opinion, then you could definitely overweight U.S. or overweight developed or overweight emerging markets. Finally, commodities. Since we hold commodities because we want some diversification and some protection from inflation, most people will just have some allocation there of their portfolio, maybe 10, 15%. We'll talk about that in the next video. But that's a very specialized asset class. You don't want to have 40, 50% in commodities because they're so volatile, but you probably want to have some allocation there just to make sure you have protection from inflation and have some diversification. What you'll notice here is when I say large cap do better in weak economies than small cap, you'll notice my footnote. I'm not saying large cap will do well in weak economies. Both small cap stocks and large cap stocks will do weakly in a weak economy. However, in a weak economy, large cap will do relatively better than small cap. Low beta would do relatively better than high beta. They both may be down and have negative returns, but high beta stocks may be down 20%, while low beta stocks may only be down 8%. So it's a relative play. So when you look at this chart, it's a good summary to really show where you're going to put your portfolio. If you're not sure, you would balance some quality. You have some high, some medium, some low. On duration, you'll probably lean toward intermediate term, and on stocks, you'll probably have a good balance between all the different categories. So in the next video, what we'll do is we'll take all of this information and we'll figure out how to exactly come up with our strategy using what we call in finance the efficient frontier.